Welcome back to HFO Multifamily Market Watch, your trusted source for information for apartment owners and investors. Multifamily Market Watch is presented by Pacific Exteriors Northwest, a contractor specializing in siding and exterior envelopes and delivering exceptional quality and service for over 30 years. And by Gantry Incorporated, the nation's largest independent mortgage banking firm.
Welcome back to Multifamily Market Watch. I'm Greg Frick, partner at HFO Investment Real Estate. Thank you again for joining us. Today we have back Charlie Kokernak, Director of Gantry Lending. You've been on here multiple times. Thanks for doing it. We're here end of July, roughly, so kind of get a state of the market, and let's just jump right into the lending environment. It seems to be changing on a weekly, daily basis. So again, thanks again for taking the time to do this. Let's just start right off the question we always get. What are interest rates today if I have a 40 or 100 unit apartment building in Portland metro area?
Sure. You're looking at something in the mid to high fives.
Okay.
Now, if you have a little bit more debt covered, we can size to something, let's say 135 or higher. We actually locked earlier this week just above 5%.
Wow, okay.
On an agency loan.
Okay.
That said, we're seeing lenders across the board get far more competitive. Spreads are compressing from April's highs, a lot of which were caused due to uncertainty in the market due to tariffs, have since backed off. And so, for the right sponsor, well-placed property, kind of on a hyper-local basis, terms can be very competitive.
So for a borrower standpoint, you've got more competition of lenders wanting to get into the market, which again bodes well from spreads and things like that.
Right. And it's really, there's a bifurcation between loans and property requests that work with, healthy debt coverage ratio, with, sponsors who have healthy portfolios, who are tenured, and then requests that are still somewhat underwater. Their income in place, or the at least underwritten income, is not sizing in order to pay off the existing financing. And so there is a plethora of lenders that want to bid on and close on requests that I would call, healthy financing. And the ones that are more of a story, while there is a market, there can be a significant gap between your conventional market terms, let's say the mid fives, and then more of your bridge option, higher leverage, that can be, sometimes 50, 100 basis points higher in pricing, but also come with other terms, either recourse or, some other structure required.
And are you seeing more of those bridge lenders coming back? They're active again and looking for those opportunities?
Yes, absolutely.
Okay.
Yeah, because they're getting paid for it.
Right. But they're getting a premium for that, for the added risk on that.
Absolutely. But they're still asking questions. It's not like 3 or 4 years ago where, if you could fog a mirror and you had permits ready to go, we could get you financing on darn near anything. At this point, they're looking into sponsorship. They're asking questions about what's happening to rents in the area. Show me the latest insurance premium, not just last year, but, where is the bill today?
Right.
So underwriting is real. Underwriting remains consistent.
So for a builder that took we were talking off camera about the lack of cranes, but somebody that got something up, a year ago, they're done with lease-up coming up. What is their option if they've got this loan that's, maybe their debt coverage is not there? What are they doing on something like that for trying to get their takeout if they can't get another extension with their existing lender?
Yeah. Well, we are talking with groups who luckily do have some time left on their existing debt, and keeping your existing lender at bay. Maybe it's an interest-only period that is floating rate, but it's not taking necessarily as much cash flow as it would be were you to go back and refinance and have excess cost. That sometimes is a reasonable solution. Some borrowers are certainly biting the bullet and saying, I understand that I want to hold this mid to long term. I will put equity in. I need to come to the table. I'm willing to lock this now. Or doing a somewhat construction loan to bridge is absolutely an option. But understanding where you are in lease up is key. Something at 50 or 60%, while, maybe 18 or 24 months ago may have been primed for like an agency type execution, as an example, at this point may not get as much traction. And so that's probably going to more of the private debt markets. And so really understanding and cutting, where's your lease up today when we're underwriting it? Where would it be when you would close? And then what concessions might you have in that market
to get there?
When would that burn off?
Okay. With the added lenders coming in, yes, there's more lenders looking and there's more competition, but they're also still, I don't want to say rigid, but more choosy as to what kind of products or what kind of opportunity they're going to look at.
Absolutely. Yeah. Just as an example, if you're looking on a non-recourse basis, so there's no personal guarantee involved, it might be something in the, let's say, high fives. Comparable would be, let's say, 150 so spread. And then if you wanted a higher leverage request, something that had a lot of structure coming from a debt fund, you might find yourself at 300 or 400 over SOFR, which is your floating rate index. Right. Now, that could be the difference between 55% of value or cost, however you're looking at it, and maybe 65 or 70 price at the higher end. And even though that's only a 200 or so basis point delta in the cost of capital, that means that 15% of the stack that you're borrowing up might have a 12 or 15% commensurate cost.
Right.
And so does it make more sense to go get an equity partner at that point? That could be a solution.
Right, which we're seeing. I mean, we're all,
Yeah.
now you've got, looking for any kind of solution, be it an equity partner, JV equity, I mean, different options, but, they're looking at the table,
Right.
how do I bridge that gap, that, the equity space here that's not going to get taken care of on an existing loan. So
Yeah.
no,
And
it's
so
an interesting kind of dilemma on how to look at that.
Absolutely. Yeah.
So then lenders are tightening underwriting. You kind of alluded to, like in insurance. What other kind of things are they, as opposed to, 3 years ago? Then we'll also look and see what's changed in the last time we got together 6 months ago. Kind of shine some light on that.
Yeah. Well, underwriting is getting hyper-local. So if you're talking about the Portland and let's say Multnomah County, Clark County area, if you're seeing a tremendous amount of concessions in one region versus the other or one neighborhood, it may be that if you look at a market report on, CoStar or some other provider, you can see that, yes, we expect to have a month or two of concessions, but then 5 miles to the west, you don't anticipate any. Maybe that owner was focusing not on driving rents, but on keeping their tenants in place. And so lenders are asking those sorts of questions.
So lenders are getting that deep on, we're just not going to take a market overview on what's supposedly happening.
Correct.
They want to know specifically on that asset.
Correct.
Yeah.
And that might reflect itself in the appraisal that we get. But, it is our job when we're going to market to be able to show why this property might or might not function with the same profile of what's happening at the broader market. So that's one aspect on the top line revenue side. We're getting questions about expanding costs elsewhere, what's happening to your repair and maintenance and your payroll. I would say management doesn't necessarily always come in to scope, but I'm sure many owners are talking with their management team to say, does it make more sense to, pay you 6%, 7%, or as low as we possibly can, but every time you go out to change a light bulb, I'm going to get a fee for that.
Right.
So,
well, that's a hard thing we've had with a lot of clients is if you just base it just on the fee of what they're charging, and there's all the other fees involved or ancillary, the upcharges, it's really hard to go apples to apples on trying to explain that. So without a track record, have what was there before, but then looking, hey, if I want to make a switch, like, hold on, it's not just, what they're charging based on the gross income. There's some other things in there, but it's
right.
very tough to kind of sit down and go through that without some kind of track record. And then like you brought up, how are they staffing? How are they doing this?
Correct.
Are there changes? Are there better ways to do that? So I'm sure it's not surprising that lenders are digging deeper into that.
Right.
Are you seeing more, borrowers pivoting towards short-term kind of bridge financing or short-term periods with the idea they think maybe rates may go back down? What's your sentiment on that?
We've seen a big shift towards 5 and 7 year borrowing or 7-year fixed with some kind of prepay after, let's say, 3 or 4 years, hedging that rates will go down.
Okay.
I would say the amount of 10-year business we're looking at is slim to almost none. I mean, to give you an idea, the CMBS market, I think, places almost no 10-year fixed funds these days. It's normally 5 years, full term interest only. CMBS is a very different beast financing wise, but as an example, is getting to the higher leverage point because they're underwriting on an interest only basis.
But it's only a 5-year fixed component as opposed to 10.
Correct. And that is a bullet loan, so to speak. So after 5 years, you have to pay that off. There's no extension options. But as far as requests from the field, most borrowers, I would say, are anticipating rates to go down, whether that's just discussion with what's going on with the Fed today or expectation that we must return to our prior market norm, which was low rates. 3 to 5 years absolutely is typical. And frankly, some fund-based lenders are willing to offer lower spreads for longer term fixed. So we have some borrowers that are longer term hold family office owners. When they see the dip happen, they think, okay, I'm fine to lock this in for 10 or 15 years. I know that even though we have these, I think I mentioned last time we talked generationally high, but historically very normal interest rates, this is the time that works. And so some lenders can say, if you want 10-year money, I'll make it worth your while.
To do that and lock it. Yeah. Does that meet the goal of the borrower and what they really want to do? Yeah.
Right. Yeah.
Have things changed in terms of the perception within, this market from specifically multifamily? Or as you said, more lenders are coming. Is that national? Is it, this market unique because we had some pull out, what we're trying to overcome with, the Portland perception? What's your take on that?
I think compared to maybe this time last year, 18 months ago, the difference in the buy-sell gap, both between sellers who think and understand what their property may inherently be worth and buyers willing to pay what they see it's valued, has narrowed substantially. And,
yes, definitely.
that's exactly what your team does and understands,
right.
Or
I
better
think
than
we'll see
are.
more we're going to see more transactions pick up. That doesn't necessarily mean that you're going to see pricing go up. I think
Right.
you're just seeing
Yeah.
sellers capitulate a little bit on pricing, getting, the idea was, I'll wait to 25 and see
Right.
what happens. Well, we're in the middle of 25.
Right.
Do you know what's happening?
Exactly.
Yeah.
Well, and that is a good thing too, because when we are going to the capital market realm, we are putting Portland, the Portland area, Oregon, Pacific Northwest in competition against other areas in the country. And if we don't have any reasonable comparables to show what is our anticipation of value, it's going to be hard to convince a lender to put their guys here versus, the Sun Belt or, Miami, for instance, which perception-wise may be on fire given the amount of development and focus going on. And so if we can show that, yes, transaction volume is increasing because buyers and sellers are coming together to, move based upon both of their values or perception of values being in line, and here are the comparables that we can show, that is a good thing. It's setting the new floor, the new basis of expectation. Whereas 18 months ago, I had no idea if that property would be $250,000 or $350,000 in value.
Right.
But the seller certainly thought the upper end and the buyer thought the lower.
Yeah, trying to do valuations last year, it was tough. I mean,
tough.
There wasn't any data points. Again, we're starting to see
Right.
some of those come back. What are the things? Is it, lack of construction? What is the Portland market in terms of what's that incentive? Is it, again, we haven't had a lot of job growth, which we can talk about that. I mean, what are some of the things that it's checking those boxes for lenders?
One major thing, we had a lender in town yesterday who we were touring through the market. It's an incredible quality of life.
Yep.
They absolutely see why this is a place that people want to live. I mean, Seattle and San Francisco, for one, are, bigger brothers, sisters, whatever you want to call them, to the north and south, that are somewhat pressure cookers where, we as a city, when we accept those jobs that will eventually want to come here, I mean, we certainly have space for them.
Yes.
It's a basis play. It's a great quality of life. It's a great geography of jobs. I see.
So kind of back to where we were like in the mid 90s when it was, Portland was this so high the quality of life, but then compared to Seattle, San Francisco, and LA,
right,
still a better quality of life, but more affordable, and you had all these jobs coming up.
Correct.
Yeah.
Right.
So the thought is that we're going to kind of come back to that. Maybe it doesn't come as robust, but we're getting, because again, we're outside. It's still
Right.
see the weather out there. We still have that. We still have proximity to the mountains and the beach. So
well, and I mean, if you're looking at a property in San Francisco or Seattle to buy, and you're looking at one here as well, the fact that you're getting a great basis and something that could be at times half of what it would cost to build right now is an absolute, well, if we understand the hyperlocality of each market within our own sector here, be it Portland or, somewhere specifically within the Pacific Northwest, I want to put my money on this coming back. Now that's, million or billion dollar question, or, when does it come back?
When does it come back?
When does that growth really happen again? But we're going to have a dearth of, supply here in the near term. There's really nothing to backfill the stock that we're seeing, absorb now.
So, I mean, when we talk about population growth, when we don't have any supply, the amount of population growth you need to offset that lack of supply is so much more, it's such a smaller amount than what we had seen before when we had all the supply. So the absorption is not going to be an issue because there's nothing really to absorb.
Right.
You just kind of, so that's going to be interesting how that plays.
Right.
Are they looking at, when we get out of Portland, some of the tertiary markets, is that coming back into vogue at all? Or what's the thought on like I-5 down Salem or up north Olympia? What's the lender's perception of those?
Positive. I mean, I would say no net change to the negative or massively positive either way. I mean, they're looking at the fundamentals of an area. Why does it make sense for this property to be here? What historically has this property done? We just signed up 5 different loans in a portfolio. They're not tied together, but on each of those, the lender required the last 3 to 4 years of operating history on each of them. They wanted also the occupancy history on each of them to dig in. Now, those are lower loan to value requests, but they want to understand, does this property operate today, and has it operated in the past, and how did it do during COVID? Although, frankly, the COVID questions were getting far, far less day in and day.
They are now.
Yeah.
I think we're seeing the same thing.
Pretty much, unless it's a boilerplate, fill this form out and tell me how the property operated during COVID. But I would say there's no major shift between, Portland as a market versus if you're looking at Salem or Eugene, but for the fact that maybe an agency lender would classify one as a smaller or a larger market. But if the fundamentals make sense, lenders want to place loans.
And we're seeing on the, on capital coming in, kind of a flight to quality, not in the standpoint of like a Class A office versus Class B, more about kind of the age of, the 90s and newer, or 2000. Is that the same thing on the lender side? Is there still that, kind of the older properties are having, some trouble in trying to get, capital, or the capital is just going to be more expensive?
Well, I mean, the capital is there across the board. I wouldn't say that lenders are necessarily digging in and saying, can you confirm for me the electrical systems or the panels in the building?
Right.
Whereas that might come up during underwriting, during insurance.
Or insurance, yeah.
And so it somewhat, rears its ugly head during some part of diligence. Whereas I wouldn't necessarily say across the field, lenders are saying, no, I don't want to do any property type this vintage or older.
Okay.
But that may just, for instance, if it's an old bricker, there are only so many lenders that will lend on that type of building, with or without the proper insurance coverage or, earthquake coverage.
Again, that's not driven from the lenders.
Correct.
So it's more on the coverage that's needed. And what's the market to get that coverage?
Correct. Yeah. That's right.
What are you seeing? I mean, what are you forecasting in the next couple of years on the multifamily side here? Are you seeing just kind of a continued momentum of job growth and, the delta, kind of getting closer? Or do we start seeing, seller expectations go up and buyers with more capital coming in here? What are you thinking or telling your clients?
I mean, I anticipate that right now you certainly in the Portland area see some people concession hopping. We're looking at a number of projects in Vancouver right now where concessions seem to be dropping off pretty quickly and absorption's happening very quickly, assuming you have the right leasing team to keep that property right in the forefront of the market. So I don't anticipate that, we will see concessions remain for long. But, I think, as I mentioned before, with a good, quality of life and geography of jobs, we just need to be ready to hopefully catch those jobs that want to come here. And I think that's going to be part of the big key is, the trickle down concept in economics is more so can we have somebody move in who then on, Friday night goes out and buys a drink, and then the person who is a bartender has the ability to go pay for their dog walker. And so that's the kind of the cycle in the economy. So, I anticipate apartments to remain strong.
And I keep telling people it's not about, it's still, we haven't fully addressed homelessness and those things, but it's really now for this region is job growth.
Yeah.
How do you attract job growth? How do you become an opportunity for, young people to come because there's job growth, and that'll help fuel. And we even had somebody here a couple of days ago talking about that. That's what funds in our state based on income tax and things like that. You need to have jobs so then people can have wages, which then pays for taxes, which then provides the services. Without that, it's just not going to work.
Well, one thing, the lender that we had in town yesterday, we stressed that we have an urban growth boundary. You cannot build beyond a certain circle around our city. Therefore, land value will stay high. And during the tour, we noted there are many parts of our city where, it is protected estuary, or it's a river, or it's a mountain, or, whatnot. And so there is a lack of generally developable sites. And the permit process will take a while to move through to actually get new buildings constructed. So unless that changes quickly and we have multiple companies coming in, I think our current stock is going to be what we have, at least a half decade, right?
Which hopefully we can fast track a little bit of that.
For sure.
But, yeah. No, but again, I don't think we'll ever get to the point of no zoning where it's just,
Right.
free for all. So we'll always kind of have those barriers of entry coming in.
Yeah.
What are you telling your clients or owners in terms of other product types? Are lenders, we've got a lot of owners that have some retail. Is it the same sentiment there, or what's the feeling?
Well, I'd say the bells of the ball right now in the investment community would be apartments and industrial.
Yeah.
In industrial, there certainly were a number of owners and users who wondered, if I have a warehouse, for instance, and it's full of stuff from overseas, will that stuff from overseas stop flowing? And so small bay industrial, for one, has a certain focus from the lending community. Many times that as well, it's significantly more expensive to buy and replace it. But, retail, which you just mentioned, has stayed very strong. Most of the Portland market has very, very little to no vacancy. Retailers will backfill. People will continue, spending money at their corner coffee shop or, bike store, what have you, which I think is very unique to the Portland market. You very infrequently see someone think, I need to go jump in my car and go to the power center. It's more, what do I have in like a 6 to 10 block radius? Right. Dynamic wise, it continues to be a strong market across the board. Office is still an ongoing conversation though. We don't really know what the future of office holds. But that said, there are people making big bets in office today in Portland still, and they're local. They understand that Portland has a future.
Well, and you're getting down to such a basis that it's just,
Yeah.
it's a basis play to get in there and
Right.
then get it and then try to figure out where it's going to go. Because I don't think anybody really understands where it's going to happen, but at where they're coming in,
Right.
there will be a path that makes some sense.
Absolutely.
Yeah, it just makes them take some time to get there.
Yeah.
So.
Yeah. True.
What do you, you brought up tariffs. Is that still coming up in conversations with lenders, or is it more tied to what's the business? Are they doing that much with overseas, importing, or how do they look at that?
Right. Tariffs are generally coming up, but I frankly think that no one really knows what will happen there. And so it's hard to even put to understand what is the right question to ask. Will tariffs affect your business? Well, of course it will in one potentially direct or indirect manner. Some businesses are very obviously tariff resistant, and lenders love to hear that. But it's much different than something that's COVID related, where it was, do you have what was the phrase, mission critical, or something where you have to be open because it's, for the public good. It's still a work in progress. We don't know what it will look like.
No,
so I would say that, maybe 1 out of every 10 lenders that we're working through underwriting will ask a tariff related question, but it's hard to have an actual objective answer.
Now, Oregon has, statewide rent caps. Washington just passed. Does that move any capital, down south from Washington? Again, I always tell people the rent caps that we have are, it's not really, it is rent control. It's, I think Washington's came out, it's going to be 9.6 or something where you can raise rents. Has that come up in conversations, or people, I know an excise tax has come up in Washington. Then Oregon doesn't, on their property taxes, how that's a little bit different, but do you see any of that?
I wouldn't say it's directly come up in conversation. I mean, we do frequently see in the real estate spectrum, a bill is discussed at, LA, for instance, had the mansion tax, and it's kind of running around like chickens with your heads cut off, thinking that the real estate market is all of a sudden going to implode. And then it passes and the sun continues to rise in the east, and there will always be that fallout of, well, I think this is the time to sell. But I wouldn't say that it's monumentally different. There has been some conversation of, is this the good time to refinance? And I'm thinking about potentially selling or refining but none of those actually came to fruition. Yeah. So I wouldn't say that it was overwhelming, but it's certainly there. But if you're talking, for instance, the 9.6% annual increase, I mean, a 10% jump year over year is strong, and theoretically 4 times inflation, right? If inflation numbers are right, so it's not nothing, but it is somewhat restrictive.
Well, I try to tell people, if you were to guarantee a certain number, I think the concern on both in Oregon and Washington is once it's in there, are you having this fight every legislative session about continuing lowering down? I think in Washington with the excise tax change, and then I don't think a lot of people in the nation understand how Oregon does their property taxes. So that always comes up as we get investors coming in this market, having to explain to them, this is how it goes. It's not going to be a massive reset. Mm-hmm. I think there's been some huge benefits for that for our region.
Definitely.
Well, thank you for taking the time to do this again. It's always been great. We'll do it again soon. I guess everybody asked me, and probably ask you, where we think interest rates are going to go. And if we all knew, we'd probably be doing something else. The good thing, I think you said, is that there's more options now than more there was a year ago. And so, again, thank you for doing that. We'll see you again next time on Multifamily Market Watch.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information. HFO is a member of Global Real Estate Advisors. Learn more at GREA.com.